Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 766A, and today's date is September 15th, 2015, and the title of this episode is The Economic Indicators Show No Sign of a Recovery. Now, before I get started, I just want to make an announcement. Tomorrow, Wednesday, I'll be uploading an interview with Craig Hemke, also known as Turd Ferguson. He's from TF Metals Report. If you're on the X22Report.com email alert system, you'll get an email. If you subscribe to X22 Report Spotlight on YouTube, YouTube should send you an email. If not, you can go right over YouTube, type in X22 Report Spotlight, should bring you right to that video. If not, you can come over to the X22Report.com site. If you look over to the right-hand side, scroll down a little bit, you'll see the interview on the right. Let's get right into the economic collapse financial news. Now, we are on this crazy ride. I mean, one day the market's down, the next day it's pushed back up. And we know that this entire stock market is a complete manipulation. It's not driven by the retail investor. It's driven completely by the high-frequency traders, the plunge protection team, the central bank feeding in more and more of this free money. And they need to continually do this to convince and prove that this economy is doing well. Everything that they're doing is working. And everyone needs to believe in them. I mean, this is what they want everyone to believe. But what we're seeing right now is that, no, this system right now is completely falling apart. And the indicators are showing us that this is not a recovery whatsoever. Out in the Eurozone, they're trying to make it seem like everything is fine. We revised this number, we revised that number, and now look, everything looks great. They're even talking about the Eurozone housing market. They're saying, oh, prices have recovered a little bit. It looks like they're sustainable, they're subdued, so it looks like we're in a recovery. No, the housing market is weak. It's not sustainable. It's not improving. It's weak. It is created, just like the rest of the private Western Central Bank countries, to give you the illusion that we're in this recovery. Because what we're seeing now is corporations, they're laying off thousands upon thousands of people. If all these people are being laid off, and the unemployment rate continually goes up, or using their manipulated statistics, they just don't count those people and their numbers go down, we see that things aren't making sense. Because if the numbers truly are going down, we would see everything expanding, everything improving with our own eyes. You'd be able to put a resume out there and get that high-paying job. We're not seeing this whatsoever. GE right now is saying, listen, we might move 500 U.S. jobs overseas. Newport News, update. This is the shipbuilding. 480 jobs, bye-bye. Los Angeles Times, layoffs are coming. We know that Deutsche Bank, Unicredit, and many others are continually laying off thousands upon thousands of people. Now they want us to believe that everything is fine in the retail market. Retail sales in August came in at a disappointing print of 0.2% month on month, missing expectations of 0.3%. If you remove autos, it's 0.1%. They expected 0.2%. If you remove autos and gas, they thought it was going to be 0.3%. I mean, they thought it was going to be 0.4%. It came in at 0.3%. So all of it was a complete miss. And this dragged the year-on-year retail sales down to a recession-looming 1.6% print. Now, they continually tell us that retail is doing fine, but this 1.6% is awful. And we're heading into the holiday seasons right now. But what's very interesting about these retail numbers is they're continually telling us that housing is in a recovery, that everything is fine. Housing prices are continually going up, except they're dropping now. Kay Schiller already pointed out, yet yes, housing prices have been coming down, but of course they're looking back at May and June. We're already in September. They have decreased quite a bit at this point. So the next report that comes out, they're going to refer to what, August? So they're always behind the curve here. But if housing is improving, we should see certain things in the market doing very well. I mean, furniture, home furnishing stores, they should be doing well. Building material, that should be doing fantastic because they continually tell us new construction is doing absolutely awesome. But when we look at the retail sales for furniture and home furnishing stores, it's down negative 0.9%. When we look at building materials and garden suppliers, it's negative 1.8%. Department stores are down negative 0.2%. So we can see at this point their recovery meme is absolutely ridiculous. It's an illusion because we would see these numbers increase dramatically if we're truly in a real estate recovery. If we look back to 2005 to 2006, going into early 2007, home furnishing, building materials were skyrocketing because the builders were building everywhere. Home sales were increasing. People were buying new furniture. We're not seeing any of this right now. We're seeing none of it, actually. Actually, we're seeing the opposite of what we saw back in 2005, 6, and early 2007. What we're seeing now is what we saw in 2008, and we all know what happened in 2008. We see business inventories. They are growing at the slowest pace since January. July's data confirms the recession looms large as inventory accumulation appears to have hit its limit, up only 0.1% month on month. So we can see at this point in time, this is another indicator showing us that something is wrong. Inventory to sales hovers at 1.36, historic recession levels. We're at that point. Empire Manufacturing in September, negative 14.67, hovering at the worst level since April of 2009. I mean, this is a recovery? Because if this is a recovery, I can't even imagine what the collapse is going to look like. The underlying data is a total and complete disaster. New orders remain firmly negative and inventories collapse, and even more concerning is employment and average work week plunged into negative territory for the first time in over a year. It's all falling apart. Let's take this a step further. Industrial production missed expectations, dropping 0.4% month on month. This is the sixth of the last 8 months missing expectations of 0.2% drop. This is the biggest month-on-month drop since August of 2012. The big driver of the decline was auto assemblies, which plunged to a 4-year low by the most since January of 2009, flashing yet another collapse indicator. I mean, manufacturing not doing well. All this buildup of autos in the dealer lots, all this channel stuffing, all this producing, people aren't buying the cars. And now production is slowing. I mean, if you really think about this, we're seeing all of the same signs that we saw back in 2008. And here we have the Fed wrestling with interest rate hikes. And of course, this is why the market was doing better, because they know come this Thursday, the Fed is going to make their decision, or no decision at all. But what happens if the Fed raises the interest rates? I mean, is it going to make it better or is it going to make it worse? I mean, if the Fed raises yields, interest rates in the U.S., that makes the U.S. currency, the dollar, more attractive. Higher yield equals more attractive, especially when coupled with liquid market for U.S. Treasuries and the relative safety of the dollar. What happens when the Fed makes the U.S. dollar more attractive to global capital? Capital flow out of emerging economies and China. The tidal flow of capital out of emerging markets in China threatens to surge into a huge tsunami should the Fed raise rates. What happens as the capital flees emerging markets in China? Bad things. 1. The currencies of emerging market nations weaken as capital flees, forcing the issuing nations to defend their currencies. Investors sell emerging market stocks and bonds to escape the downside of currency devaluation. This crushes the stock and bond markets in the emerging economies. 3. Investment in emerging economies dries up. Global growth largely depends on the rapid expansion of emerging economies. They grow about 5 to 8% annually, while developed economies only grow between 1 and 2%. Number 4, as the dollar strengthens versus emerging market currencies, a self-reinforcing feedback loop is established. The more U.S. dollars rise, the more capital flees emerging markets, pushing those currencies down. And we know what happens when they're pushed down. Stocks, bonds, real estate, they start to fall apart. We saw this happen. China had to devalue the yuan. All the emerging economies are going to devalue their currency to try to help the situation. China then will dump even more treasuries to raise the capital to do this, to support yuan and the markets. This is what's going to happen. And if they raise the interest rates here, we're also going to see real estate take a hit, auto loans take a hit, student loans take a hit. The debt is going to start to get harder and harder to sustain. And like I said, most likely, if they're going to do anything, they'll raise it just a little bit to show the world, to show everyone in the U.S. that we're in a recovery. But we won't be, because we will see the ripple effects. We will see problems start to occur. And of course, they're going to turn their blame to China, the emerging market, saying they're the ones to blame. Because look, they're devaluing their currencies now. Well, they have to survive. And that's not going to help anything. Now, if the Fed decides not to raise interest rates, we're stuck where we are. And everyone looks at the Fed and says, I thought you said the economy was recovering. What's going on here? You know, of course, they might use the excuse, well, we'll look at it in December, and then we'll make our decision then. Now, of course, they're hoping that they get something started, like a war, an event. But we know this next financial crisis is not going to be like 2008. 2008 is going to look like a little blip of nothing, like a walk in the park compared to what is coming. Because we have to remember what happened in 2008. A lot of people lost their wealth, their retirements, their homes, their jobs, their credit. Most of them never recovered, never got back on their feet. So that was all lost. And now we have those people who didn't lose anything. That's the next wave. And the situation, the central bank will not be able to get out of this. Yeah, they can print, they can try to keep the illusion alive, but everyone is going to lose faith in the central bankers because they're going to say, it's not working. It didn't work the last time, this is why we crashed. It's not going to work again. This way, if they blame it on another country or group, they can say, it wasn't us. We raised the interest rates. Everything was fine. And then all of a sudden, something happened. An event. And we need to blame this country, that country, or this group. And this is what they're preparing for. And if they're preparing, everybody needs to be prepared. I mean, let's think back for a second here. Back when Cyprus had bail-ins, everyone said this was a one-off thing. Don't look over there. It's nothing to see. And we see right now in the last 24 months, Canada, Cyprus, New Zealand, the US, UK, and Germany have all implemented legislation would allow them to first freeze, then seize bank assets during the next crisis. Well, let's look back at Cyprus and what happened here. June 25th, 2012. Cyprus formally requests a bailout from the EU. November 24th, 2012. Cyprus announced it has reached an agreement with the EU. The bailout process once Cyprus banks are examined by EU officials, and they're looking at that they need about 17.5 billion euros. March 16th, 2013. Before I go to this date, let me just let you know, in December of 2012, the UK and the FDIC here in the United States created the bail-in document. It was published. March 16th, 2013. Cyprus announces the terms of its bail-in, a 6.75% confiscation of accounts under 100,000 euros and 9.9% for accounts larger than 100,000 euros. And a bank holiday was announced. March 17th, 2013, emergency session of Parliament to vote on bailout bail-in is postponed. March 18th, 2013, the bank holiday extended until March 21st. March 19th, Cyprus Parliament rejects bail-in bill. March 20th, bank holiday extended until March 26th. March 24th, cash limits of €100 in withdrawals begin the largest banks in Cyprus. March 25th, bail-in deal agreed. Those depositors with 100,000 euros either lose 40% of their money in the Bank of Cyprus or lose 60% in Lucky Bank. The process didn't happen all of a sudden. It was gradual. But the people did wake up and the banks were closed. And they had a tough time getting their money out. So they were able to freeze the bank accounts. And they were telling the people it was only going to be 6 to 9%. That's all. But they lost much, much more of this. The average was about 47%. And there were no warnings that this was going to happen. The same thing is going to happen now. And this is why everyone needs to be prepared. I mean, there are clear signals that the feds are preparing for something big. The Treasury Department has ordered survival kits for the big bank employees. The Treasury Department is now holding cash for a year. The New York Fed is expanding its satellite offices in Chicago. NORAD is refurbishing Cheyenne Mountain. I mean, think about what's happening here. They are getting ready and prepared for what is coming. This is why you all have to get prepared. This is not going to be a warning, and you're not going to see on the news saying, oh, by the way, everyone, in 2 weeks, there's going to be bail-ins, and by the way, the economy is going to be collapsing, so whatever supplies you need now, you better go out and get it. No, what's going to happen is they're going to make up this ridiculous story just like they did in the 70s when people couldn't get fuel, when they were taking us off the gold standard and putting us on the oil standard, and people had a very rough time filling up their cars. Things were crazy. People didn't have jobs. This is going to be worse because that was the beginning of the cycle. This is the end. And there will be no warning. It will be too late. This is why you need to get your food, your supplies, your weapons, your gold, your cash, your toiletries. You name it, you need it. If you're just starting now, you can go to lifereliance.com. They have bug out bags. They have food. They have water filtration systems. They have seeds. You can customize it. Get it all in one shot. If you're going to the big superstores, warehouse stores, continually do this. Continually get everything that you need. Because you will need it. Now, Do I have a crystal ball here in front of me, letting me know the exact date? Nobody knows the exact date. These central bankers, they will do whatever they possibly can to push and kick the can down the road. They tried this in 2008. They pushed, they kicked. And guess what? It finally collapsed. It couldn't go any further. Back in 1929, they did the same thing. Here we are 7 years later. Look at all the signs. Look at all the indicators. They're telling you. It's just a whisper now, but listen to it. Because if you don't listen now and you hear the screams later, it's too late. We even have the analyst who said buy Lehman 20 days before it collapsed is now on the Financial Stability Oversight Council. He was telling you that everything was going to be okay. Lehman is going to be fine. Go ahead and purchase Lehman. Well, Patrick is now one of the top placed people in charge of the U.S. Treasury's FSOC. That's scary. Because they're never going to tell you the truth. They're never going to tell you what's happening. And this is why you need to be ready. This is why everyone needs to do research, look at what's going on, make the decision and say, yes, you know something, things aren't right. Things are not what they're telling us. And I need to get ready. I need to protect my family. I need to tell as many people as I possibly can, if they'll listen. And I know that's hard for a lot of people to do. I mean, it's hard for me. A lot of people don't want to hear it. A lot of people are in la-la land. They think everything is fine. If you told them before 2008, they wouldn't listen. Things were good. Back in 1929, there were plenty of people out there telling everyone that something's wrong, something's going to happen. Don't you see the bread lines? Don't you see the soup lines? No, those are the poor people. Don't look at them. And then all of a sudden, everything just completely fell apart. Just like in 2008. We had a lot of people warning that something bad was coming. Nobody wanted to listen. Everyone was listening to the government. Everyone was listening to the corporate media. Well, we know it's coming. We're looking at the indicators. We're looking at the information that tells us we need to be concerned about what's happening. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.